Back in early 2026, the crypto world got absolutely hammered by a massive crash. And, it wasn't just one thing that caused it. No, this was a perfect storm. A whole bunch of different forces that all hit at the exact same time. So today, we're going to unpack exactly how that storm came together. To really get a handle on the crash, you have to start at the absolute peak. It was October 2025, and Bitcoin had just hit this staggering all-time high of over $126,000. I mean, the market was just pure euphoria. Everyone was riding high on what they called the Trump trade, this belief that the new administration was going to be amazing for crypto. But then, fast forward just 4 months to February 2026, and the picture looked completely different. The price? It had collapsed all the way down to $60,000. Yeah, that's a 50% drop in just 4 months. The speed of it was just brutal. It completely wiped out every single gain made since the election, and it left the entire market in a state of shock. So what happened? I mean, how do you go from that kind of extreme greed to absolute fear so fast? Well, this was no random event. It was a chain reaction, a perfect storm, caused by the convergence of 4 very distinct and very powerful forces. The first force was a massive macro shockwave. You see, the story of this crash, it doesn't actually begin in the crypto markets. It starts in Washington, D.C., with one single political appointment that sent tremors through the entire financial world. On January 30th, 2026, President Trump nominated a guy named Kevin Warsh to be the next chair of the Federal Reserve. Now, here's the real irony. Warsh had actually said some friendly things about crypto in the past, but the market, they didn't care about that. Nope. All they saw was his reputation as a hard money advocate, a monetary hawk. And that signaled one thing. The party for easy money was over. Warsh's whole philosophy was basically kryptonite for assets like Bitcoin, which absolutely thrive on liquidity. He hated quantitative easing, printing money, because he thought it just created asset bubbles. He believed in financial discipline, which is code for no more Fed bailouts. And most importantly, he wanted high real interest rates and a smaller Fed balance sheet, both of which suck money right out of the financial system. The market's reaction was immediate and, frankly, violent. Bitcoin plunged 15% almost instantly on fears that the liquidity tap was about to be turned off. At the same time, the US dollar surged because investors were betting on higher rates. Gold, well, it dipped at first, but then it found its footing as a classic safe haven. The takeaway here is that the war shock just fundamentally reset everyone's expectations for the global economy, and Bitcoin was pretty much the first casualty. Okay, so that macro shock sets the stage for the second force, a full-blown identity crisis for Bitcoin. For years, the big sales pitch was that Bitcoin was digital gold, the asset that would protect you when things got chaotic. Well, in early 2026, that theory got put to the test, and it failed, spectacularly. Geopolitical tensions were flaring up between the US and Iran. There were new sanctions, fears of a bigger conflict. I mean, this should have been the perfect moment for a non-government, censorship-resistant asset to really shine. This was Bitcoin's big chance to prove that whole safe haven story was true. But it didn't, not even close. As the crisis got worse, traditional gold did exactly what you'd expect. It rallied hard, pushing towards $5,600 an ounce. Bitcoin, on the other hand, totally decoupled. It plunged from 80K down to 60K. It didn't trade like gold at all. It traded like a risky tech stock with a really high correlation to the NASDAQ. As hedge fund manager Michael Burry pointed out, Bitcoin just failed its big test. When real fear gripped the markets, institutions didn't run to Bitcoin for safety. Instead, it was the first thing they sold to get cash. The market spoke loud and clear, and it confirmed Bitcoin's true identity. Not digital gold, but a liquidity sponge, a high-risk asset that soars when money is cheap and gets dumped the second fear takes over. So we have a macro shock and an identity crisis. The third force, well, this one came from inside the crypto market itself. The very things that fueled the bull run, they became these powerful engines of destruction on the way down, creating a vicious death spiral. It started with the ETFs. In January 2026 alone, the spot Bitcoin ETFs, which had been this huge source of buying pressure, saw net outflows of $1.6 billion. The tide had officially turned. And this created an incredibly dangerous negative feedback loop. Here's how it worked. The price starts to drop, which spooks investors, who then sell their ETF shares. This forces the fund issuers to sell actual Bitcoin on the open market to give investors their money back. And this selling, it's totally mechanical. It doesn't care about the price, it just has to happen. This pushes the price down even further, which causes more panic and more selling. It's a brutal, self-reinforcing cycle. And at the exact same time, the derivatives market was just imploding. On February 5th and 6th, over $2.6 billion in leveraged positions got liquidated. And get this, a staggering 95% of those were long positions. The market was overwhelmingly betting on higher prices, and they all got wiped out at once, just adding to this waterfall of selling pressure. And to make matters even worse, a lot of the sharpest drops happened over the weekend. During those times, traditional banks are closed and the big institutional players are less active. This creates what's called a liquidity crunch, where even small sell orders can cause these huge price drops, which in turn triggers even more liquidations. And that brings us to the fourth and final force, the one that really delivered the final blow, a crushing wave of selling pressure that came from the very people who secure the network, the miners. The problem was just simple, brutal math. By early 2026, because of rising energy costs and network difficulty, the average cost to mine a single Bitcoin had climbed to around $87,000. But with the market price sitting at $60,000, well, you can see the problem. Miners were operating at a massive loss for every single coin they produced. This led to a phase we call miner capitulation. And look, this isn't about panic selling. This is just a business decision. To pay their electricity bills and just stay afloat, miners were forced to sell their Bitcoin reserves that they've been saving. This flooded an already weak market with a steady, relentless stream of supply from sellers who had absolutely no choice but to sell, no matter what the price was. So there you have it, a macro shock, an identity crisis, an ETF-driven death spiral, and finally, miner capitulation. It was the perfect storm that plunged the market into a state of extreme fear. But even in the absolute depths of that crash, the debate about Bitcoin's future was far from over. Even as the market was burning, JP Morgan offered a pretty surprising perspective. Their strategists pointed out that from a long-term, risk-adjusted view, Bitcoin was actually starting to look attractive again. They argued that if Bitcoin ever managed to play a similar role in portfolios as gold does, its long-term price could be as high as $266,000. The 2026 crash was a brutal stress test. It exposed some really deep vulnerabilities in both Bitcoin's story and its market structure. And it left us with one ultimate question. Was this just another painful but temporary crypto winter? Or did it reveal a permanent, fatal flaw in the world's largest digital asset? The answer to that is going to define its future.